So note investors were buying loans from private lenders, banks, home loan traders, hedge funds, or brokers. And what we're doing is we're purchasing these notes, these loans, at a discount, and we'll talk about why here in a second. And then what happens is we become the lender of record. So I don't know if anyone listening today has ever purchased a home and they have a loan, and within a few months, usually it's about 90 days, they get a letter, and it might be longer, but typically we got our first one when I purchased my first home. It was about 90 days later, I got a letter in the mail that said, hey, Chase Bank has sold your loan to Citibank. Citibank is now your new lender of record, and all payments are to be sent there. That's the sale of a loan from one lender to another. That's what note investors do. They become the lender of record. They're the ones sending out those letters. That's what 7E does. So fun fact, if a loan was held for about 30 years, which most loans aren't, people refinance, they move, but if a loan, it would be sold an average of 7 times. So this isn't something that, happens every once in a while. Banks, credit unions, funds are selling and buying loans on a consistent basis. And again, we'll talk about why in a little bit. So as the lender, as the note holder, what you're doing is you're purchasing the rights to the borrower's future mortgage payments. So you're the one collecting those principal and interest payments and the right to repayment according to their note. So
yeah, and one thing I just want to add to that is, as the bank, we step in the shoes of the bank. We don't own the property. I think that's one thing a lot of people sometimes struggle with, thinking that, oh, you're buying the property. No, we're just the lender. So if a toilet breaks, if your toilet breaks, I'm assuming you don't call your lender. Same thing, if our borrower's toilet breaks, we don't get that phone call. We just deal on the payment side.
yeah. However, it is secured by the home. So there is a difference. Being secured by the home means that, say it was the lender or the borrower decides, I'm not going to pay. And that, therefore, just as a bank, the lenders have rights to go through the foreclosure process, at which point they could take back the property. That is very rare. But again, you do have the right to repayment via the security of the property. So.
And we'll talk a little bit. We've done other videos about what a note versus a mortgage is. That really delineates, the note is the IOU, the mortgage is that security that allows you to go after the property if they fail. So 2 types of loans that we look to acquire are performing and non-performing. So what is a performing loan versus a non-performing loan?